Now, a question often comes up when I get into these topics, which is, well, aren't modern people just spending more money on discretionary items? And the answer is no. We are simply in a different economic time frame than we have ever been in the past. So most people, when it comes to our personal finances, most people end up learning through making some mistakes and correcting them over time. And the margin for mistakes is thinner than it has ever been historically. We can get into some data to see this. Most specifically, we can look at the personal savings rate over time. So what this chart is going to show us is the personal savings rate all the way back to 1960 into the modern day. And what we see when we look at this is that the personal savings rate for people back in the 60s all the way through the 80s was somewhere around 10% and above of their take-home pay. Now, in the modern world, we can see that this rate has continued to decline over time. Of course, there were some strange aberrations that we see happening after COVID happened with the extra stimulus introduced into the economy. The savings rate bumped to an extremely high level for some amount of time. But since COVID, we are back down to levels that we see in the trends pre-COVID. And most recently, we saw that the average savings rate for a personal savings out there was 3.6% of take-home pay. Extremely low compared to those rates of 10 and above percent that we saw back in the day. Now, the question often comes up when we start to discuss this, isn't more money simply going towards discretionary spending? And the answer is no. So we can again look at the chart supplied by Fred that goes with real disposable income going back all the way to 1960. And what we'll see is if we take the trend line from 1980 and we inflation adjust it for today's dollars, we find that we come up with $18,460, whereas in 2022, the amount spent on disposable income, disposable items, was $16,000, right? So we are not simply spending more money on discretionary funds as a whole. Instead, there's other reasons for why we're seeing the margin for error in our personal finances be thinner than it has ever been. And really, these are highlighting some of them. Before I even get into the data, let's just think about three of the big factors in our personal finance. There's housing, there's amount of student debt, and I'm not even going to show this one on this chart, there's childcare. All three of those expenses are far higher than they have been historically, and those are three of the big rocks in our financial jars, if you will, right? So when we look at those three factors, we can tell that we're living in different economic times than we might have been in the 1980s. Getting into some of the specifics here, if we look at the cost of tuition, all of these numbers are inflation adjusted. You can see the unadjusted values in the parentheses next to the inflation adjusted value. The cost of tuition, fees, room and board in 1980 was an inflation adjusted $11,000. That has more than doubled to $28,000 in 2022. The starting salary at the same time with a bachelor's degree, well, that was an inflation adjusted $53,000 a year, as opposed to today, it's $54,000 a year. So you can see that although the cost of tuition, fees, room and board has more than doubled, the average starting salary with a bachelor's degree is basically the same. The same is true for median family income. And keep in mind that in 1980, we had far more single income households than we do today. We have far more two-income households today than we had at that time. And yet the median family income at that time was an inflation-adjusted $74,000. And today it is exactly that, $74,000. At the same time, the median home price was an inflation-adjusted $227,000 in 1980, whereas it is almost doubled to $442,000 in today's world. And we can see similar trends when it comes to median rents, almost doubled again. Now, if we were to take a look at what the down payments would be on these types of houses, Well, we can see again that the trends are completely different than they were historically. So the median home price of $64K, not inflation adjusted, in 1980, well, that would have been a down payment of around $12,800 for somebody, which for a median family income of around $74,000, well, that was, at the time, that was a unadjusted value of $21,000. Well, the $12,800 is just over half of that person's annual income of $21,000. In today's world, the down payment on a $442,000 place, well, that would come out to around $88,400, which, as we can see, that's more than the entire median family income for a year in this case. So we are in a different economic world than we were previously. And the point here is that employees at all income levels are stressed financially. And financial stress impacts employee productivity. Employees' priorities are shifting, and more they are beginning to look towards employers for help in these regards, since our society doesn't provide any type of foundational financial education for us. And yet, employers have a business to run. So in terms of creating foundational financial education support programs for employees, it becomes pretty challenging. And this is where we at OnTap Credit Union have stepped in to help to provide a solution in these regards. Cheers to you and your financial freedom.